Wish was founded in 2010 as a discount e-commerce app, sort of like the online dollar store. Wish sells everything from Bluetooth headphones to baking sheets, and it sells it at 80 to 90% of its original price. The key to its model is that consumers trade price for convenience. When you place an order on Wish, it takes 2 to 4 weeks for your order to arrive. Wish places an order to its Asian manufacturers and ships directly to you. While many discount retailers have to hold inventory for you near the location where customers buy their products, Wish ships directly to you, saving money. That's how they can offer the lowest prices. In contrast to Amazon, which competes on both price and convenience, Wish only focuses on price. It turns out that many customers care mostly about price. To grow early on, they leverage Facebook and Instagram ads. They became notorious for their, let's say, strange advertisements. Let's take a look at its revenue. Not surprisingly, most of its revenue, 93%, comes from its marketplace services. The remaining 7% of its revenue comes from its logistics services that they offer to its merchants. In the fiscal year of 2019, the revenue was around $1.9 billion, up from $1.7 billion in 2018 and $1.1 billion in 2017. In these graphs, you can see that their growth has been slowing down. Let's see what's happening to this company. It's not uncommon for value retailers like Amazon and Costco to have a low margin in its retail business. Costco famously makes most of its margin on its membership fees. But there is a big caveat for Wish business model. The model efficacy is dependent on a shipping discount policy set by a Universal Postal Union treaty. But the future of this law is, let's say, at least murky. For those unfamiliar with the Universal Postal Union, they are a specialized agency inside the United Nations that aims to organize and improve postal services throughout the world. They were founded in 1874 to facilitate international trade. While some of the principles created by this agency, like uniformity of weight measurement, were obvious, it also created discounted shipping rates to and from developing countries. As part of the program, the US agreed to subsidize exports coming from developing countries. These subsidies applied to parcels moving from China to the US, and many companies took advantage of it, including Wish. But now that China became a much larger country, the US decided that they didn't want to have these discounted rates, as it hurt US businesses. A new deal was signed in September 2019, and new rates that were set by the US were set in place in July 2020. That in turn increased shipping rates from China. And you can see that this is affecting Wish business. While you can see that their gross margin has remained the same from 2017 to 2019, their gross margin has decreased in the past year. So their gross margin has gone down, and it could keep going down. But one of the most concerning things about its business is its rising customer acquisition cost. Customer acquisition cost, or CAC, is defined as the price to acquire a new customer. Even though the LTV, or lifetime value, of its customers have gone up, its CAC, or customer acquisition cost, has gone up, as you can see in their S1. They mentioned that their 2016 cohort achieved a 2.8 LTV to CAC ratio by year 4. They also give hints of what's their CAC for other years. Putting it all together, in 2017 between $15 and $25, and in 2018 was between $19 and $27. Their CAC is increasing linearly, and you can see in their financials that they're spending a lot more money and their growth has basically stalled. In 2018, Wish spent around $1.5 billion to increase their LTV users from 52 to 64 million active users. And more concerning is that in 2019, they spent $1.4 billion and their LTV users decreased from 64 to 62 million users. That's not so surprising when you learn that their NPS score is really low. When we look at their user data, look at these two graphs. Their daily active users has been increasing, but their LTV hasn't increased as much. The number of people that buy in Wish has plateaued, even though in 2020, even more people have moved online due to COVID. So let's take a look at their valuation. First of all, I don't think Wish is a wonderful company. Their acquisition cost has been increasing, their gross margin has been squeezed due to rising shipping costs. I'm not confident about their unit economics, and their NPS scores are really low. Of course, they have some positive attributes due to e-commerce tailwinds, and their LTV has been increasing over time. Their latest private valuation was around $11.2 billion, with revenue of around $1.9 billion in 2019 and free cash flow of $23 million. That's a hefty valuation for a low growth company. We'll see how the market responds to its IPO. Leave any comments down below of what you think about Wish, and I hope you have a great day. Bye.